How's it going out there? Welcome to Stock Talk with Mike. So I want to talk in this video about where I think we're at in this market. It's fairly interesting. We've obviously had Bitcoin and other cryptocurrencies sell off fairly hard as of late, although Bitcoin's recovered a little bit nicely this past weekend. And some of the meme stocks flying high and selling off and whatnot. But you strip that away and you look at a lot of these stocks in the index funds or whatnot, and it's actually a bit of a boring market. It's been trading fairly sideways. S&P 500 has been trading kind of close to all-time highs, sort of sideways for a while now. And I want to talk about what I think this means and where the opportunities lie in the market, particularly since some of that tech wreck and the particular growth names have sold off pretty heavily in March, where there could be some opportunities in this market. So if you're not already a subscriber, please consider subscribing to the channel. It'd also be great if you like this video. I want to start here with a chart of the QQQs. This is a good representation of tech stocks and some of these high growth stocks that sold off pretty hard back in March. You can see from the all-time highs that we saw sort of into mid-February, sort of the peaks there. The QQQs are trading over 140 and it's dropped down to as low as 123 there in March during the tech wreck, right? This was 10-year treasury real yields, concerns of that hitting closer to 2%, concerns around inflation and what's that going to mean for these growth stocks that have pulled forward so many years of growth into these models and how that could affect them as well. So we saw this huge rotation into value, and I think in a lot of cases, sometimes that meant sacrificing some quality, just finding some of the cheapest stocks in the market from a valuation perspective, from a price to earnings ratio, from a price to sales ratio and whatnot. And we saw these high multiple stocks in particularly sell off pretty hard. And I'm going to give you some examples here of actually it's kind of the sell-off, but also what we've kind of seen and why the market in general. This is where I think there can be real opportunity for the average investor, is that the market is so overreactive that if you just take a step back and think about it, there's always some opportunities. So tech was just selling off indiscriminate. So yeah, I understood. It wasn't surprising that the high flying, high valuation, highly speculative ends of the market as well, like SPACs and whatnot, that maybe some pre-revenue companies were selling off really hard. These companies are really hard to put a valuation on where they should be trading. So people were really risk off and starting to trade into more of the dividend stocks, very blue chip stocks trading at a good valuation. But look at here at Nvidia. It had peaked earlier in the year at $617 a share back in February. And during that tech wreck, it traded down as low as $463 a share. So it dropped about 25%. So certainly not as big of a sell-off as we saw in some of the other high growth names. And this is definitely a high growth name and gets kind of lumped in that category. But it always traded at a modest valuation. This wasn't one of those sky high crazy multiples of like 50 times sales. It was trading in the sort of the mid 40s to maybe even like 50 times earnings, right? Not sales. So it was definitely sort of a steeper valuation, but you could definitely argue that Nvidia deserves a premium multiple. So even though I've been in Nvidia some time, I was actually kind of buying accumulating more shares of Nvidia on the way down. And you can see that reaction of like, get out of tech, and people are changing their investing philosophies into becoming all of a sudden these value investors. And I think you need a more long-term view. It's good to have some value in your portfolio, but you want some quality growth stocks as well for the long term. And you definitely want to be accumulating shares, in my opinion, or I am accumulating shares of Nvidia. And look at that opportunity. We've actually seen now about a 55% gain from those lows back in March. It was a fantastic opportunity if you'd been watching Nvidia. You don't want this isn't the kind of company you want to be buying at all-time highs. You want to be buying on those kind of sell-offs, right? Nothing really changed the underlying company. It was all these external factors and sort of the macro that people were worried about. Nothing's particular really about Nvidia. So it is up 55%, and even right now trading at all-time highs at $718 a share. So it's just kind of blown those February highs out of the water now. And you know, if that ARMS deal goes through, look out, Nvidia is going a lot higher. A lot of analysts have raised their price targets to 800 and beyond now. So yeah, Nvidia, fantastic company and doing really well. Yeah, definitely no sign of that tech wreck there. Next is C Limited, and this is sort of the e-commerce play that's definitely trades at a premium multiple as well, fairly expensive. And its all-time high is $285 a share, and that was back in February as well. And then in March, during that indiscriminate sell-off, dropped as much as 34% down to $189 a share. And it actually traded up, almost recovered all that, and then dropped right back down there again. That's a pretty huge fluctuations, right? And right now it's at $279 a share, within 5% of all-time highs, up 48% off the lows. So that's the interesting math of that opportunity, right? When a stock drops 50%, retracing that back to those all-time highs is 100% gain. So that's why if you are trimming and taking some profits as these rise and you have some cash, how you can really benefit from these sell-offs and hold these companies through these sell-offs and actually do pretty well. I held all my growth companies through the tech sell-off, and I'm still up in 2021 because I was adding on those big pullbacks, and on that new money, it's actually performed quite well, right? So you got to remember that math there. So C Limited, you had a bit of an opportunity there twice there in March, but then again around mid-May as well. And it's climbed right back there near all-time highs, currently trading at $279 a share. That's C Limited, ticker SE. Crowdstrike. So this is an example of a really high multiple stock that I own. That definitely I was a little hesitant to add to this one aggressively, and it's kind of sitting in the mid-range position in my portfolio. I didn't aggressively add to this one. I did add a little bit, but not as much as some of the other growth stocks in my portfolio, just because it does trade at such a high valuation at over 50 times sales, right? These are the companies that I thought are definitely trading at a high multiple that definitely could see a sell-off even if the companies are performing well. So I had taken some profits previously in Crowdstrike in the 200s. And I did add a little bit here on the sell-off, but yeah, it's still trading fairly expensive. But we saw about a 33% sell-off in Crowdstrike, so pretty significant, obviously. But again, we saw some companies sell off a lot more than that. But its all-time highs were at $251 a share back in February, traded down to around $168 a share there in late March. But again, we've seen about a 38% increase off those all-time highs here in short order. Currently trading at $232 a share, just like 7% or so off all-time highs. So it's kind of like nothing happened, and this is in a pretty high multiple stock in Crowdstrike. In the meantime, they've been killing it. They just reported fantastic earnings, but that was kind of expected. But I think people, definitely the sentiment around these kind of stocks has been so negative. Yet, it's done quite well, and there's been actually some huge opportunities here this year to get into some of these companies and have some phenomenal returns year to date. We're only in June, and these three companies I've listed so far in Crowdstrike, C Limited, and in Nvidia, you could have been up 38%, 48%, 55%. Of course, you're not going to time the bottom exactly, right? But it just goes to show that sometimes you take some of these companies that are executing their game plan well, and you look for some of these big pullbacks, especially indiscriminate pullbacks. There's potentially some huge upside gains that can be made on these stocks. But it isn't all roses. These are some other high growth stocks, high multiple stocks that I own in my portfolio that I've kind of worked around a position I'm doing fairly well on overall, but haven't performed very well year to date still after that tech sell-off. So they haven't fully recovered. We got Shopify here, ticker SHOP, big small business e-commerce play. I think it's a great long-term hold. It's still down about 14% on the year. It has recovered quite a bit off its troughs its trough lows there back in March, but it still has quite a ways to go and still down on the year. Airbnb is one I've been accumulating lately. It's been performing a little better, but still well off the all-time highs and is down over 6% still year to date. Palantir, ticker PLTR, big data analytics play, down just over 5% on the year. I've picked up some more Palantir here as well at some lower levels and lowered my cost basis on Palantir as well. So I'm up on my of where I've added, but still pretty flat overall based on my position in Palantir currently, and it hasn't quite fully recovered on the year. And these are still, I mentioned these are down on the year. They're down substantially more still off the all-time highs. So I still think there's some decent buying opportunities here. Square is almost recovered on the year, but still down well off the all-time highs. It's down almost 1% year to date. And Square, I have a pretty low cost basis, but this is one I actually added to and increased my cost basis on when it dipped there, I think around to the 189 level or so. I was adding some, and just a great quarter from Square, and a company I want to be my largest position in my portfolio. It's around there. It's in the top 5, but Square is one of my highest conviction stocks in my portfolio. Next is Teladoc. Ticker TDOC, so obviously the telehealth virtual medicine play. It's still down over 22% on the year and well off the all-time highs, off almost 50% off the all-time highs of I think it's we're over $300 a share. Is just skyrocketing up there early on in the year, and then it's sold off hard. Teladoc's an interesting one. I think it's actually quite interesting here. It's still only trading at around 15 or 16 times sales, which is expensive, but this is a company growing at nearly 100% revenue clip right now, and expected to be in that range of 40 to 100% revenue growth for the next 5 years anyway. 40% is projected over the next 5 years, but 100% I think for this year. And so you think about that. If this stock trades sideways for another year, it could be trading at 8 times sales. And at that point, it'd be cheap, right? That becomes almost a value play. So I really like it here. I don't think this is just a COVID play, which I think is getting a bad rap for that this is a high flyer COVID play and it's going to go away when COVID is gone. And I don't think that could be more wrong. They're definitely the leader in the telehealth space. My biggest concern with them is competition, but they were growing incredibly fast pre-COVID. So this, in my opinion, I don't think virtual medicine is going away. There's just too many efficiencies. People have gotten used to this kind of lifestyle and using virtual communication for work and whatnot, and just avoiding the hassle, driving to the doctor's office and all that, and be more productive, missing less work, etc. So I think employers and health plans are going to continue to buy these telehealth products, and Teladoc's the leader. It's the largest, and it's gaining the market share the fastest. So if you're going to be in telehealth, I think Teladoc is still the play. And lastly, Unity I threw in here as well. So I got 6 stocks that are still pretty beaten down. It's actually done, it's been on a nice steady climb as of late, but it's still down over 30% on the year. So I think it traded down into the 70s, and it's kind of worked its way up to close to around $100 a share here again. So good, like 30% or so gain, but still well off the all-time highs. Really interesting play as a 3D engine to build 3D video games, but also I think one thing analysts are missing and investors are missing is their runway of growth into other industries outside of gaming that is going to continue to propel them forward as we bring 3D into different aspects of business. So I think there's still some opportunities out there, and I wanted to show you these stocks because I think it's a really interesting time in the market. Is we've also seen some of these value stocks do quite well, and they're not that cheap anymore for the type of earnings growth and the type of revenue growth that these companies have. And I think what you're going to see is a bit of a battle between the growth and between value. And that's really good. It's becoming a stock picker's market again, where quality is going to win. Earnings reports are going to matter over time. And some of these stocks that are trading sideways are going to be posed to well positioned to take off as they execute and they report good earnings. So I like this kind of market. We're seeing some disparity. We're seeing some stocks recover quickly here. We're seeing others kind of trade sideways. The sentiment isn't positive. So you really want to pick your spots and look for companies that you think are trading at a good value based on their company metrics. Obviously, like a growth company is going to have a higher valuation than like your traditional blue chip value company that isn't growing is going to have a better valuation. So it's all relative to the industry and the type of company you're investing in. And you have to remember that. I think it's too easy to get caught up in like, oh, I'm not going to buy any companies that trade over a PE of 20. Right? And you're going to miss a lot of opportunities. I think it's important to concentrate on valuation, but you need to look at comparables in the industry and the type of company you're investing in, and look at it that way. You see it with Apple. I think people think Apple's actually trading expensive because you look at its historical PE and it's trading at a higher PE now than it has over the last 5 years. But you could argue it's cheaper because you have to remember that Apple's business has changed. It used to be completely a hardware play. And you look at consumer hardware or products, they trade at very low multiples. Whereas now, a huge percentage, I can't remember the amount, but like maybe even the majority or almost half of Apple's business now is a subscription model, which always warrant a higher price to earnings multiple than hardware stocks. So it's going to trade at a higher PE ratio. And that's just how subscription companies are valued and have a history of being valued. So you can't always just look at a historical PE for a company, and you can't compare different industry and different types of stocks with the same kind of valuation metrics. So one thing to keep in mind, I like to focus first on the company, where I see it headed, the CEO and their vision, and then I want to look at the valuation metrics and some of those fundamentals. But I focus on the company first, and then those metrics. But it is important, right? You always got to pay attention to value. But I think there's a room for a little bit of both in there. And you don't want to completely lump, even though I'm completely tilted towards the growth side, I still pay a lot of attention to value. And you never ignore valuation, right? And that's really important. So don't get totally lumped into one side or the other on it either. And don't let this market well you to sleep. I think there's a lot of opportunities out there. So that's what I got for you today. So thank you so much for watching. Best of luck investing. Take care.